Hey everybody, it's Daniel here from InfoRest. Hope you're all doing well. So it's an important week this week because we have the US Federal Reserve coming out to discuss their monetary policy. This is where the Fed comes out, decides whether they're going to hike or not, what's their plan for future interest rates, for what's their thoughts on inflation, money printing, etc., etc. So we're going to get all that information this week, Wednesday, and this meeting's important because it comes with the dot plot and the projections. Now, the dot plot is basically what the FOMC members think where rates will be this year, next year, and the coming years ahead. It also has projections in this meeting where you're going to hear that, okay, not only where interest rates are expected to be, but also what's their thought on GDP, unemployment rate, growth data, inflation metrics, etc., etc. You'll have more information regarding monetary policy in those projections and also in their statement. Now, it's expected that in this meeting that they're not going to hike. So they're going to pause. Now, does this mean that this is a pause forever and they're done forever? Not necessarily. They can definitely come back and hike again. But what's going to be important, the most important thing to watch out for are those projections. Now, they're projecting that rates in the last meeting, they're projecting rates to be around 5.6% this year. That means another rate hike is expected this year. Now, what's going to be very key that's going to move the markets is, do they change that number? Do they change it? Do they change it higher, which means that they expect more rates than expected? Or do they revise it lower, which means that they're done? They could signal that they're completely done for this year. Or do they revise it lower and add more rates for the next year? They did put in that they're expected to cut starting next year, but that can definitely change every time the data comes out. Now, with that number and with understanding what's coming out, the markets and the bond market and the stock market is going to react accordingly, whether they see that this press conference or this statement or these projections are considered hawkish or dovish. If it's hawkish, that means the FOMC is projecting higher rates for longer than what the markets are expecting. And if they don't signal any kind of pause, you can definitely expect some sort of tantrum or a little bit of a panic sell in the equity markets. How long will that panic sell last for? We don't know. It all depends how the FOMC communicates the projections and what they say also during the press conference. So the first part of the meeting, you're going to get the projections and the statement. Half an hour later, they're going to come out, they're going to have a press conference, they're going to answer some questions, and that's also going to be important to see where they see the future of interest rates, where they see the future of the economy, growth, and so on. Now, it's quite obvious, as we've been hearing from before, that the central bank will never come out and say, hey, we're going to head to a massive, ugly recession. Although they did say that, the recession risks are there, but they're going to do their best to basically sound that, hey, we're going to try to, aim for a soft landing, and it looks like we are seeing that soft landing. They'll always push out the narrative of soft landing. Now, whether we get it or not, we will see. I think we'll probably more see a hard landing with all the tightening we've done. And if they decide to keep rates higher for longer and leave the door open for another rate hike, especially with oil prices that are moving up higher, definitely, I don't see how things can look good for the economy for the next year. So that press conference, those projections are all going to be key in market moving for the equity markets and, most importantly, the bond market. Now, the one little caveat to all of this is, what if they come in as expected, sounding hawkish as expected, not overly hawkish, but in line, right? Saying that, hey, we're data dependent, which is very possible. And if they sound that they're pushing out the data dependent narrative and saying that, hey, we're going to hike, and if needed, if not, we're going to keep it where it is, then sure, yeah, you could get the markets to initially maybe panic on it, but then get bought up right away and rally all of a sudden. And then that means going forward, it's going to be really, really, really important to watch the data, watch the CPI, watch the upcoming growth data that comes out, the jobs numbers. Are those going to continue to be hotter than expected? Are they going to come weaker? If it's weaker, then that means they don't need to tighten more. That means they may do another pause again, right? If it comes in, hotter than expected, then the market's going to react to it. So the markets are going to be really jittery around data, because if data comes in hot, if oil prices continue to go up, you see $100 per barrel oil prices or higher, obviously the equity markets can react on that. And also same thing with the CPI report and so forth. So keep an eye out on that. Wednesday, it's going to be really important. Take a look at the projections. Very key. The most important thing are the projections there. They're what they think about rates. That's going to be the focus there. And of course, afterwards, the press conference, how Powell answers the questions, and whether he's going to sound in line hawkish, more hawkish, or maybe signal some sort of pause. And if he signals a pause, definitely you can expect a nice relief rally in the equity markets and the bond markets. Let me know what you guys think. Leave a comment below, subscribe, hit the like button, bell icon to be notified on the next video, and I'll see you guys around. Cheers, bye.